So, welcome back. Let us continue our discussion about the interest rate, the zero rate, the forward rate, and so on and so forth. So, at the fag end of this, we were discussing that what was the forward rate, and based on that is basically the agreement between two parties depending on the rates which are prevailing in the market. So, what rates you will consider would be either the zero rate or the forward rate or the par yield. That will depend on what type of problem you are trying to solve, and also conceptually how you are trying to build an interest rate into the model. So, we are discussing the theories of term structures. In the last class, I just mentioned the highlighted points. So, in expectation theory, long term interest rate should reflect the expected future short term interest rate such that forward rates equal expected future zero rates, which means that the interest rate based on which you are trying to do your calculation for the forward rates should exactly equal to futures zero rate such that any coupons you will consider for these transactions would be of zero value. For the market segmentation theory, short and medium and long term interest rate determined independent of each other. So, whatever the zero rate it, whatever the forward rate it is, and whatever the long term interest rates are, they would be calculated independent of the fact or whatever calculation which you have done so far. And in the liquidity preference theory, that forward rate should always be higher than the expected future zero rates, because that would be true, because in the future we will always consider the interest rate are increasing in such a way that it makes sense for you to go into a forward and futures and so on and so forth, because a forward and futures are being brought into the market in order to basically hedge your overall risk. So, some other definitions we will consider: what are the day counts conversions, what are the quotations for the bonds, and what is the treasury bill. So, we will come to that, but first let us go into the details of how the swaps calculations are done. So, swap calculations is very important, at least for trying to find out that how you can basically convert a liability to an asset into a liability, how you can convert a floating interest rate to a fixed interest rate or vice versa, or how you can basically convert one currency risk on another currency depending on the mutual advantage and disadvantages a party or basically an institution faces in the market. So, if you talk about the duration of a bond, the duration of a bond is a measure of how long on an average the holder of the bond has to wait before receiving the cash payments. Hence, a zero coupon bond that matures in 8 years has a duration of n years. However, we can say that without any problem that a coupon bearing bond maturing in n years has a duration which is less than n year, because duration means the actual time between which you will basically get back the total amount of money which you have invested. So, obviously, for the bonds they would be coupon payments. So, if there are no coupon payment bonds, then the overall duration definitely n, because you will get the total amount of money after n years. But if they are coupon paying bonds, obviously you are getting back some money intermittently or in between the time frame which is less than n years. So, obviously your duration on the bond would be calculated accordingly. So, now how do we find out the duration on the bond? So, duration of the bond is basically given by this formula, which is very simple to understand. So, now if you consider that B is the price and Y is the yield, which is the continuously compounding yield for the bond and per annum basis. So, what you have is three terms. One is the price of the bond, that means you divide it to find out that the equality holds for the duration such that the duration can be calculated accordingly. Now, what are these? T1 is the time, and the value of Ci into e to the power minus Yti is basically the overall value of the present value of the overall investment which is being made at some point of time T1 down the line. So, consider this. So, say for example, your total amount of payment which you are getting after T1, this is the T1, is basically C1. So, what you will do is that you try to find out the present value of the C1. So, that will be what? C1 into e to the power minus y into T1, which is the first term if I is 1. Now, if you have basically C2 amount which is being paid, again you want to find out the present value of the C2 value, that will be plus C2 into the e to the power minus y into T2, which is the value when I is equal to 2. So, if you continue and find out all the values, obviously the last value would be the case where it is the face value FV, which is 100, plus the coupon which is being paid, which is Cn, into e to the power minus y into basically Tn. So, this value which you have, the value which you have here, which is the face value plus Cn in the bracket is the Cn value which you have here when I is equal to n. So, that is being just given in a general symbol. So, obviously, the first value which you have is C1 into e to the power minus y t1 is the present value of the first coupon. C2 into e to the power minus y t2 is the value of the second coupon which as of now, and if we continue adding these terms which is C3 into e to the power minus y t3 plus C4 into e to the power minus y t4, so on and so forth. So, the last value which you will have according to this equation would be Cn e to the power minus y Tn, but actually Cn value is the face value which is 100 or 10 whatever it is plus Cn value which is the coupon which is being paid. So, hence you will basically multiply it e to the power minus y Tn and then find out the values. So, now these are the values which you have when you add them up. Now, what you need to do is that value is basically multiplication of two terms. One is the time period term and one is basically the amount term. So, once you divide by the value of the b which is the price, then the actual terms or the units which comes out is the duration. Based on the duration you can say that what is the time period at which you will get back the exact amount of the money which you have invested for the bank for the bond. So, now as I mentioned that if there are no coupon payments, obviously the duration is exactly n years. If there are coupon payments, obviously it will be decreased by the total duration of n, and more the coupons are being paid as of now in the initial years, lesser with the duration, because you are already getting back the overall amount of investment which you are doing for the bank for the bond. Note the term in the bracket is the ratio of the present value of the payment at time t1 to the bond price. So, this is basically the present value divided by the bond price, and this leads us to the case that the rate of change of the bond price with the initial value of the bond is equal to the negative of the duration with respect to the yield rate. So, if say for example, if you ignore the minus sign for the time being considered, if this is negative, delta b by b is negative, then obviously the signs between d and del y should be such that del y in also in that case should be positive, because if this is negative you already have a negative sign. So, negative into the positive, it would basically give you a negative direction of movement or delta b into b. If this is positive, so obviously it can mean that this is minus, and obviously this case should also be minus, as that minus into minus should basically give you a plus sign. So, remember that the relationship between the bond, its yield rate, its coupon values and obviously its duration are interrelated, such that given one set of information you can definitely find the others and find out what is the characteristics of the bond which you are dealing with. So, now suppose another example we are just trying to discuss. Suppose that the zero interest rate with continuous compounding is given here. So, this is the first column which you have, the maturity in years, the rate interest rate which is given in per annum percentage continuously compounded. So, you are required to find out the forward interest for the second year, third year, fourth year and fifth year. So, what you need to find out is basically from 0 to 1 your zero rate is 12. So, basically if you start from 0 to 1 this is 12, if you start from 0 to second year it is basically 13. So, you are required to find out the interest rate between the first and the second year, which is this. Again, if you have the interest rate between 0th rate from 0 to 3, you are required to find out the interest rate between the second and the third year, which is basically this. So, if you continue doing this you can find out the zero rate between these time periods. Also you can find out the 0th interest rate. Given the 0th interest rate, you can find out the forward rate between other type of time period frames also. Consider this again, the same example. From 0 to 1 interest rate is given as 12, from 0 to 2 it is given as 13, from 0 to 3 it is given as 13.7. So, these three values are given to you. Say for example, now what you need to find out is basically what is the forward rate between the first and third year. So, obviously you have to do the calculation considering the 12% interest rate and 30.7 interest rate, which are continuous compounding per annum case, and you can find out the forward rate for the time durations also. But we are omitting and requesting the students to do the calculations on their own in order to understand how the calculations can be done, that given the zero rate you can find out the forward rate, or given the forward rate you can find out the zero rate. A 5-year bond with a yield of 11% continuous compounding pays a 8% coupon at the end of each year. Then find the following: the bond price, the bond duration. Using this duration, calculate the effect of the bond price for a 0.2 decrease in the yield. So, that means delta y would be decrease, which is minus 0.2% in the minus sign. Recalculate the bond price on the basis of 10.8% per annum yield and verify the result in the agreement. So, this value which you have is 10.8 is basically y. So, obviously, you will have the rate of change of this bond, you can basically have the rate of change of the price of the bond, and given the information or the calculation which you have already done depending on the bond price, the duration and the rate of change of the duration with respect to the yield, you can find out what is the relation between all these values which you have already discussed. Now, we will start off the discussion of the swaps. So, we will cover, and this is a little bit lengthy chapter and not very difficult conceptually, but it will give you a whole lot of information depending on how risk can be mitigated, how different concept of quantitative finance are utilized in order to find out how swaps are utilized to reduce the risk. We will discuss and cover interest rate swaps, currency rate swaps and valuation of the currency rate swaps, and later on discuss in not much detail, but in conceptual sense how different type of interest rate plus currency swaps can be utilized in order to mitigate two different type of risk. What are the risks? One would be interest rate risk, that means interest rate risk would basically pertain to those parties who are facing some risk on the front of floating rate and they want to convert it to a fixed rate, or the parties who are facing a risk on the fixed rate and want to basically convert that to a floating rate. That is the one type of risk based on interest rate. Another set of parties would be who are facing risk based on the fact that there is currency risk. That means I have Indian rupees and I face a currency risk on US dollars, or else I have US dollars and basically I face a currency risk on Indian rupees. So, I want to basically convert my currency from one currency to the other, or from say for example, Indian to dollar rate I want to basically convert to Indian to yen rate, such that my overall risk basically mitigates. That we are also going to consider, considering different type of swaps. And later on we will combine the interest rate and the currency rate swaps in such a way that I can reduce my risk on two different fronts. So, swap is an agreement in general between two parties to companies to exchange cash flows at some specified future times according to a certain specified rules. While on the other hand, a forward contract is simple, an example of a very simple example of a swap, but in the forward rate there is only one exchange. While for a swap, we will basically consider that the exchanges are happening at some interval of time and some fixed amount of money is being exchanged between these two parties. Why they are going to do that? We will see that very soon. Whereas a forward contract leads to exchange of cash flow on just one future date, swaps typically lead to cash flows exchanges on several future days, and it continues at intermittent times. So, intermittent times are of equal duration, but once we decide, the swap will basically continue for that duration and equal amount of money would be exchanged between these parties. Example, on 1st of March 1999, a company enters in a long forward contract. So, let us highlight these. So, long forward, you know what it is basically a long forward contract to buy 100 ounces of golds at 300 per ounce. So, obviously, once you multiply, you can find out what is the price of the total gold. Immediately on getting that gold, it can short that gold for 100 into ST, where ST is the spot price which will happen at time t is equal to capital T. Note it leads to a cash flow on just one futures date, but swaps typically would lead to cash flows on several such future dates, but they would be intermittent and the interest rate and the amount transacted would also be decided by these two parties. So, swaps can be interest rate swaps, simply they are called the plain vanilla. The company basically agrees to pay cash flows equivalent or equal to an interest amount which is calculated at a predetermined fixed interest rate on a notional or principal amount of exchange which is happening between these two parties. In return, the company receives an interest rate amount which is calculated at a floating rate on the same notional amount for the same period of time. So, one party is basically trying to exchange money on a floating rate, another party is trying to basically exchange amount of money on a fixed rate. But it may so happen the party which is being told to do on a floating rate may find it much more advantageous to do on a fixed rate, and the party which is being told to do on a fixed rate, it is much more advantageous for that party to do on a floating rate. So, what they would try to do is that initially there would be a fixed and floating which is definitely not advantageous to them. So, now With that condition, they would basically go into much more other transaction with other parties, which is basically the swap, such that one is able to convert his disadvantageous position from a floating now to an advantageous position, which is a fixed, and the other party which was basically facing an disadvantage on the fixed rate will now convert into a floating rate. So, how it is done, we will consider that. And on the other case, for a currency swap, again as I mentioned, if some party is facing risk for a US dollars to Indian rupees, it will basically convert his position from Indian rupees to a US dollar, or it can convert his position from the US dollars Indian rupees to a yen to rupees also, depending on what it thinks is best for his or her overall financial transaction, such that it wants to basically minimize its overall risk. So, important is that for this portion, whenever we quote an interest rate, they are always given per annum on a continuous compounding basis. So, remember that. So, even if you have interest rate which are given per annum on a compounding basis, or per annum on a compounding on m number of times, first calculate all the interest rate on per annum basis on a continuous compounding basis, and then do your calculations accordingly. So, whether the interest rate is given on a fixed rate, whether the interest rate is given on a floating rate, whether the amount of transaction which is being done, if there is interest rate for foreign currency, if the interest rates are given in any other terms, first without doing any calculation, convert that into per annum continuous compounding rate, and then do your calculations for the swap. So, let us consider the simple example of a swap. Consider a hypothetical 3-year swap which is being initiated on 5th of March 2001 between Microsoft and Intel. So, because Microsoft, in order to sell its computers, it needs chips, and the chips are basically made by Intel. So, we suppose Microsoft agrees to pay Intel an interest rate of 5% per annum on a notional principal amount, say for example of $100 million. So, this percentage which is given is basically fixed, and this is the notional amount. And in return, Intel agrees to pay Microsoft a 6-month LIBOR rate. The LIBOR rate is basically the floating one. If you remember the London interbank offer rate, London interbank bid rate, or equivalently in India with the Mumbai interbank offer rate and Mumbai interbank bid rate. A LIBOR of 6 months LIBOR on the same notional amount, principal amount of 100 millions. We assume that the agreement specifies that the payment are to be exchanged every 6 months onward. So, basically this is 3-year swap. So, in this 6-month period, it will basically be paid after 6 months, after 1 year, after 1.5 years, after 2 years, after 2.5 years, and 3 years, and that will end the overall contract for the swap. So, now this is the cash flow for the Microsoft. So, obviously for Intel it will be just the reverse. So, what you have the dates: first 6 months, 1 year, 1.5 years, 2 years, 2.5 years, 3 years. So, all the dates are given on the first column. The LIBOR rate, if they are as this, so it is 4.2, 4.8, 5.3, 5.5, 5.6, 5.9. So, this is the LIBOR rate which is happening. The total amount of transaction which is going to take place would be with the amount of money cash flow, and this is positive because the cash flows from the point of view of Microsoft. So, this will be on a 6-month basis. So, plus 2.1, plus 2.4, plus 2.65, plus 2.76, plus 2.8, plus 2.95. And on the other hand, because the payment by Microsoft would be done on a fixed rate. So, if you remember, I told about the fixed rate which was there. So, the values are fixed. So, it will be minus 2.5 throughout. So, if I want to find out what is the overall net cash flow, obviously it will be a difference on that. So, this minus, so this will basically be a net outflow of cash of minus 0.4 for Microsoft for the first year to the 6 months, then the first duration to the 6 months, then from the 6 month to the 1 year it is again a minus, then from the 1 year to 1.5 years it is plus, from 1.5 years to 2 years it is plus, and so on and so forth. The values are given. So, this minus and plus basically means what is the inflow and outflow cash which is happening between Microsoft and Intel. Now, if I look at the cash flow for the swaps point of view for Intel, it will be just the other way around. So, obviously, the values which you have here for cash flows for Microsoft, they get swapped. Swap means they get exchanged. So, this would be the inflow for Microsoft, for Intel in the other diagram, and this will be the outflow happening for Intel. So, obviously, Microsoft and Intel, when they add up their total transaction, it should come out to be 0. For this example, if you see very carefully, we notice that the cash flows in the third column are basically the cash flows for a long position in a floating rate. The cash flows in the fourth column are the cash flows for a short position on a fixed rate bond. So, obviously, the cash flows are for a long and a short, but the interest rate based on which you are doing the calculations are fixed or floating. The table can be regarded as the exchange of a fixed rate bond or for a floating rate bond, and Microsoft is long on a floating rate and short on a fixed rate, while Intel is just the vice versa position. So, remember that first you will try to analyze what is the position of both the parties, whether they are long and short on a floating rate or a fixed rate, or say for example, you are considering the dollar to rupee rate, or say for example, dollar to yen rate. You will try to find out that parties are long and short on with respect to what exchange rate. Based on the exchange rate, you will try to basically understand which is advantageous for party 1, which is advantageous for party 2, and basically exchange the position with respect to swap, and then try to recalculate the calculations such that the overall risk is minimized. Typical uses of interest rate swaps are done to convert a liability from a fixed to a floating or a floating to a fixed, and for other instant to convert from the investment, you are basically trying to convert from a fixed to a floating or also to a floating to a fixed. So, your main concern is basically convert the liabilities or convert the assets. So, whether they are basically the assets or the liabilities, you want to basically reduce your overall risk from a floating to a fixed or a fixed to a floating. So, this remains same, assets or liabilities remain the same. The overall risk based on which you are going to term or find out your total liabilities or total assets is either a floating or a fixed or a floating, such that you are able to minimize your overall risk. So, now we will basically use a swap to transform our liability. So, suppose Microsoft has arranged to borrow 100 millions at LIBOR plus 10 basis points. So, 10 basis points is basically 10 divided by 100 percentage or point over and above the LIBOR. So, interest rate is LIBOR plus 0.1 percentage. After MS has gone into a swap, it has followed 3 sets of cash flows, which is pays LIBOR plus 10 basis points to the outside lender. So, now a third lender is also coming for a Microsoft, and a third and a fourth lender will come also coming for a Microsoft, for the Intel. So, it receives LIBOR under the terms of the contract which is signed with Intel in the first instant, and it pays 5% under the terms of contract which is basically signed with Intel. So, Intel and Microsoft were exchanging from forward and futures. So, now in the second instant, Intel will go with another transaction with a third party outside, third party to itself, and Microsoft would also go with a third party to itself. So, now in the total number of players who are there in the market would be Microsoft, Intel, and 2 third parties. So, initially if you see the graph or the transaction, it was basically Microsoft and Intel. Now, if you see, there would be a third party for Microsoft and a third party for Intel. So, I am just drawing the lines, I am not denoting the arrows in which direction they would be. So, we will slowly consider that, considering that initially it was Microsoft and Intel who are going into such transaction, in the first step we bring 2 third parties, and later on we will also see that in order to mitigate the risk, we will basically bring a financial institution between Microsoft and Intel, such that the overall transaction is not anymore between 2 parties, but now there would be 5 parties. One would be the third party for Microsoft, second would be the Microsoft itself, third case would be the FI, which is basically in between Microsoft and Intel, fourth one is Intel, and the fifth party would be the third party for Intel. So, we will see that how you can basically reduce the overall risk as you basically go step by step in order to formulate a swap. We will continue the discussion of trying to formulate the swap in more details for this example, and then basically go into the currency rate swap, and then also see how currency and interest can be combined together in order to formulate very sophisticated swaps such that the overall risk is minimized for both the parties who are there in the transaction. Thank you very much.